So a VC at a conference explained to me their business model as follows. They seek to buy as much of your company as they can for as little money as they can get away with. So I really appreciated that honesty and clarity. Having said that, they typically buy minority stakes in companies. It's rare that a VC will seek to become the majority owner. Other things to bear in mind when they're buying your company or a stake in your company, there's a fair amount of informational asymmetry there. You may be a first-time founder, or maybe you're a serial founder, but they invest in small companies and startups for a living. So having said that, it pays to lawyer up. Get some legal advice, not only to read through the documents, but to help you and support you in your negotiation of the investments. It should not be seen as an adversarial move, and it's a smart thing to do, worth spending some money on. Another thing, and I've got some links in the video below, consider using, where possible, public source, open source, founder-friendly documents as a starting point. These are available from entities like Y Combinator and others, and I've got a bunch of links below the video to help you out there. VCs usually want an element of control that is out of proportion to their economic interest, and that's understandable, a way of protecting their investment. So bear in mind, when you bring on venture investment, you're going to be giving up some control, sometimes quite a bit of control over your company. That's why I always encourage founders to look at alternatives and don't necessarily consider the venture route as the default. There are grants, there are SBA loans, there are finance joint development agreements with customers, and guess what? There's good old-fashioned revenue as a way of bringing cash into your company as an alternative to the venture route, which I strongly advise you to consider very, very carefully and very, very thoroughly before, just as I said, as a default, going down the venture route. Now, just like PEs, VCs make money by selling companies, and so they're starting with the end in mind. They're looking at the exit, conditions for an IPO, past history, similar transactions, obvious strategic buyers, combinations. This is all part of the investment thesis at the very beginning. It's something you as a founder should be thinking about. Honestly, regardless of whether you go down the VC route or not, if you have in mind a liquidity event for yourself as a founder in the company, you ought to be thinking about what that sale looks like and what the valuable components of the company are going to be, as well as obviously the business plan, the revenue, the earnings, things like intellectual property and other moats around the business, which are going to contribute to how value the business is going to be considered to be. Failure is a significant part of the venture business model. You've heard the saying, most new companies fail, and that's something that VCs plan for. They're going to expect 1 or 2 investments out of 10, let's say, really hit it out of the park and drive returns for the whole fund. There's a chunk of their investments do kind of okay, and there's a significant chunk that are going to fail, that are going to be liquidated, that are going to be sold for parts. And that's just a fact of investing in high-risk ventures, but it's something you, again, as a founder, need to bear in mind when you bring on a VC as an investor in your company. Having said all that, venture funds play a significant and useful role in the chemical industry and in surfactants in particular. Companies like Amphistar, Disperser, Ruby Bio, Hollyfirm all have benefited significantly from venture investments, and we'll provide some links and some news articles again below the video. So I hope you have found this useful in terms of figuring out how venture funds work and the role they play in our industry. Going forward, we might dig a little deeper into the difference between financial funds and corporate venture arms. Thanks again for listening.